Hi, Randy Zogbaum again. I'm just trying out a new piece of technology, so we'll see how this goes. I wanted to share some of the things that Paul Dietmann from Badgerland Financial shared with the face-to-face course for the folks in the face-to-face course. This will be maybe uh, reinforcing what Paul talked about last Friday, and for those that were not able to be there, just a chance to see this. A lot of the things that we talked about, a lot of the items that Paul talked about, we will be getting into a little later in this course and developing for either for your own farm situation, the tools that we will be taking just a quick look at here, uh, or if you're not in a farming situation, we'll be using a in-farm case scenario to develop the tools that way. Well, let's just keep on going. We'll see how we do. Good. Well, Paul Dittman did come. Paul Dittman is emerging market specialist for Badgerland Financial. He's been a good friend of mine for a number of years, and probably one of the better farm financial analysts that I've known. He spent a lot of his last 20 or so years of his career really diving into farm financial analysis and working with a number of farmers throughout the state and the region. You came and talked a little bit about what is this, the financial planning aspect of business planning. We haven't quite got to that point yet, and we will in a short time get there. But he did, that's his background, and shared a little bit more on the financial part of business planning and why that's important for farm business. Of course, some of the things here pointed out that Paul pointed out, having your finances in place so allows you to think about your farm from a business standpoint, to take a look at performance, and especially early in a process, and understand, am I making the right decisions financially as well as production wise. Of course, taxes are a part of everybody's life, so having your financials in order is a good, makes that lot less painful for doing tax preparation and planning. It's a way to measure progress over time. Are the decisions we're making helping us make our farm more profitable? Are we getting more of our dollars back? When you're choosing to be a farmer, you are making a decision on where you're investing both your time and money, and having the tools, financial tools, to analyze whether that's a wise investment is a good thing to have up front, rather than to find out, well, you're out of equity or out of cash and you don't have a way to keep this farm going, and the next thing you know, you're going into bankruptcy. If you are managing or interested in getting financing for the work you're doing, of course, having your financials in order is something a bank is definitely going to require, along with the rest of your business plan here. And it's also a way to make quick changes that are when they're needed, if they're needed. Paul shared this quote, and I kept it in here, something that I like this quote as well. The next best thing to finding out you're right is to find out you're wrong as quickly as possible. That was from John Manley, the chief equity strategist for Wells Fargo. It just, we're not always going to be right when we make financial decisions. That's never the case in any kind of investment that we make. The idea with some of the tools that we're going to take a look at, though, is that maybe we can tell quickly that we're wrong before we're so buried in the mud there's just no way to get out. That's one of the keys. Paul shared, and I agree with this. We're going to talk a lot about the farm as a business in this class, but of course, farming isn't just a business; it's really a way of life. And quality of life goals are really, really important to keep up front too. In fact, that's exactly what we're doing by writing out the narrative part of our business plan that you're working on right now, an ag plan, and with our sustainable, building a sustainable business book and worksheets that are part of that. Of course, if you're not economically sustainable, quality of life goes downhill in a hurry. It's you're not going to do well if you're not able to put food on the table and pay the bills. So, they kind of go hand in hand. A couple of the big issues to think about here is on the financials is the first one really is cash flow, which is real, short term over the course of a year. Are we able to have enough cash to pay the bills and keep the farm running throughout the year? That's the long and short of it. Profitability is more of a long-term view. It's also important, but it really is, that's analyzing whether or not your investment in time and money into the farm is building and growing over time. In order to be long-term, in order to be economically sustainable, you need both of those. We'll get into how to take a look at that in a little bit. Paul covered 3 tools that are useful for that forward planning to understand cash flow, and then 3 financial statements that you need to measure the progress over time, the profitability aspect. And we are going to dive real deep into those, so I'm just going to cover them quickly in this part of the class. The 3 pieces that you are part of understanding your farm on a monthly basis, on a first year basis, and as Paul points out in his slide here, you need to do this even before, as you're starting up your farm and getting off the ground. Enterprise budgets, your monthly cash flow projection, and then developing a record-keeping system, particularly, Paul suggested particularly for tax purposes, but a good record-keeping system also drives back to these other 2 with their enterprise budgets and monthly cash flow projection. Having a good record-keeping system will help you develop, as you go into your farming career, they'll help you develop both of these tools much quicker, much easier. In order to understand your profitability, there's 3 financial statements, and these are actually, there's good templates for these right in the egg plan, and we'll get to that in a minute, but you need to do an annual balance sheet that is suggested to be on January 1. Of course, that doesn't mean that you stop watching the football games on January 1st to sit down and do that, but just to take that look at your time as close to January 1 physically to do it. Use that date as the key date in your farm's year. Your income statement, and then an annual cash flow statement. Those 3 will help you. Those 3 documents will give you the ability to analyze your farm's profitability. So what are profitability and cash flow? They're related, but they're very, very different. Cash flow is exactly that, the amount of cash that comes in and out of the farm, and that's you want to have a positive cash flow, preferably every month, otherwise you're going to be in a little bit of a tough time. You can be profitable with negative cash flow, as Paul points out. That's not a very good situation to be in long term, but you can also have a strong cash flow and be unprofitable. I guess what that boils down to is that you're just not reinvesting in some of the farm, and you're going to end up losing that. In the long run, that's going to erode at your profitability. The cash flow is definitely critical in the short run. Cash flow is looking at whether or not you have money today to pay bills today. So profitability is more of a long-term thing. But you need both to be economically sustainable in the long run. All right, so some of the tools that you would look at are actually even maybe before you start to farm or as you're getting into farming. These are some things you can do right now to help you make decisions. I know a number of you are looking at different aspects of where you want to go or how you want to do a farm. So here's a couple. These couple tools will be important to go ahead and start planning. Right, help you decide which way you might go with your farming future. The first one is developing a simple enterprise budget that takes your expected gross revenue from whatever you're producing. And you can do this, you can set up different enterprises for enterprise budgets for any different enterprise that you are growing on your farm. If you have multiple enterprises, it's a good idea to set up enterprises for each one. But then you're going to take that and you're going to compare it to your costs for production, variable costs and overhead costs, and then take a look at that. Will give you your net return. It's also known as a break-even analysis. You can take a look at it from that perspective, as like, how much do I have to get for a crop to know, am I making money? How much do I have to sell my crop for to get my money back out? That's another way of using the enterprise budget. I didn't really talk much about that aspect, but that's part of it. All right. So taking a little closer look at what the costs are that we're dealing with here. Variable costs are the costs that increase as you increase production. Things like seed, fertilizer, fuel, that kind of things always go up as you're producing more. The overhead costs can be looked at as the costs that would exist whether you are actually producing anything or not. They're part of owning the farm and owning what you've already invested. The variable costs, of course, are relatively easy. You have your bills for seeds and fertilizer and fuel and that kind of thing every year, so you can take a look at that, and that gives you your variable costs for that particular enterprise. Overhead costs can be a bit more difficult, as you're looking at how you, for one thing, you're looking at 1 year of production, so you're annualizing costs for long-term assets like machinery and vehicles, buildings, that kind of things that are more capital investments. The other part of that is, how much time and energy do you allocate for that machinery, for those buildings, to this particular enterprise in a given year. A little tricky. There's some guidelines that we can dig into as you get into it. The big thing, I guess, is being consistent year to year at how you do this, so that you can compare. As you're building year to year tools, you can really compare and tell whether you're making a difference in your production versus just changing your accounting system. I wanted to show this just as an example of the enterprise budget that Paul kind of come up with from an example farm that he worked through. We're not going to go through it much, but just for the ones that didn't get a chance to see that, this particular farm had estimated that they're going to have a $36,000 plus gross income per year. Some of the variable costs they broke out, seeds and plants, fertilizer, other supplies for this. It's a vegetable farm, so plastic mulch, that kind of thing. They hired labor, so that was a part of that. Utilities for this part. There's some costs for doing marketing, and then they had fuel and oil. Their overhead costs, the land, how much they charge themselves for the land, per acre of land there. What they decided to do in this case was to take what is the average rent or going rent for an acre of land in the area that they lived in. It's a good tool to use as a measure if you don't have an exact, as a way to come up with the money there. They had repairs and insurance for the items needed for that, and then they just lumped together other overhead costs in this case. Came up with their total, and then their net return per acre on this vegetable farm on a vegetable CSA of $17,000 per acre. So the next tool that Paul shared with us was looking at a monthly cash flow projection for the year, and taking a look at where cash comes and goes over the course of the year, so that we know that we have money on hand for that. So to do that projection, Paul suggests using your enterprise budgets, which is a fine way to do that. As you get more and more years into production, you may have your own records to base that on. Then, of course, your beginning cash on hand. If you're working off farm, what is that non-farm income? You got to add up and take out family living costs, plan capital investments or sales for the year, if you're planning on any new borrowing for the year, and then payments on existing debt. So you can break that out. Paul shared this template that he developed, and I'll share a resource with you that you can develop your own. We should have this one as well. This is an Excel spreadsheet that Paul's wife had actually developed for him. But it takes a look at the inflow balances and outflow balances and then total amount for each month of the year. Sorry about that. And then each month you look at what the beginning cash balance is and where you're at. Total ending cash balance for the year. One of the points that you can see then is where am I light? Where am I going to have trouble? Well, at the end of February, we're $5,000 in the hole. You do that too much and you're going to be in a lot of trouble. So maybe when you're looking at that, how can we find something that we can do a little differently to balance out our year here so that we have cash flow making it throughout the year. So from the Schedule F, you can start to get to a point of developing into an income statement and into your statement of cash flows. But it really isn't a statement of cash flows. It's because it excludes some of the cash items and also includes non-cash items. It's not really an income statement because it doesn't take into account changes in inventories, accounts receivable, payables, etc. But you can get there. It's a good place to start from. So that's why Paul recommends working from that, and it's also something you have to do anyway. So it's probably the point where most farmers, all farmers, have to do this. So it's a good point for if you haven't developed these other tools, then to start from. The other tools, which we are going to develop in class, are a balance sheet. The balance sheet takes a snapshot of your farm investment, your investment in the farm at a single point in time. So it looks at your farm business assets and compares that to financing methods or liability. So it looks at your owner's equity. All right, taking a look at a balance sheet, which is something we're going to get into a little deeper. A balance sheet takes a snapshot look at your farm business at a point in time. The recommended point in time to do that, of course, year to year is January 1. That helps you line up with your taxes, of course. But having that same point in time every year allows you then over time to compare back and see if you're growing your financial position. The balance sheet looks at all of your assets, everything that is owned or by or payable in the business on the date of the balance sheet was prepared, against liabilities, all your obligations that were owed by the business on the balance sheet of that date. And then it tells you your owner's equity or net worth, which is total assets minus the total liabilities. And hopefully the positive is left over. What are some of the things that are good about a balance sheet? It helps you document the value of a business asset at a point in time. It shows progress that you are making in the business, even if cash flow seems tight. So when you start next year's balance sheet, you can see, am I growing this business? Is my net worth actually growing? It also aligns with your federal tax return, which makes financial analysis easy. There is why, again, the driving home the point of January 1, that helps you with your federal tax return year. Some of the key information that you can get from a balance sheet: the liquidity, which is taking a look at whether your business can meet its current liabilities with current assets. The short term, that's generally over the course of a year. You can also take a look at what's called the solvency of your business. So that's saying if your farm was sold tomorrow, will the business be able to pay off all its debts if it were to be sold tomorrow? This is actually the balance sheet that is part of Ag Plan, that you can download this exact form when you look in the financials, and I'll show you how to get to that. It's in there. It's a fillable Excel spreadsheet. Just wanted to share with you a good example of that. If you have other examples, that's fine. You'll note in this one, it's looking at the difference between, I went through an example of how to use this to look at changes in net worth, and looking from January 1 of 2014 to January 1 of 2015 is how you would do that. So working capital, that's again what you're looking at with the balance sheet. It is a key measure of risk that lenders are going to take a look at if you're trying to get financing, but you should also be looking at, are we risking our investment here long term? The suggested rate is that you want to be, your working capital should be at least 15% of your annual gross income. Having a strong working capital position allows the farm to withstand any unexpected setbacks or take advantage of an unexpected opportunity. Neighbors' farm comes up. So Paul then showed us how to take your schedule off in a balance sheet and how we can start to analyze profitability. The income statement is the next tool that you go to. It takes a look at 1 year's income and expenses, and how much profit was generated by the farm. It's not a cash flow statement because it doesn't include non-cash items. But another name you might have heard of is the profit and loss statement. Again, we're going to get into these in a lot more detail in not too distant future, but just to kind of give you an overview of how Paul measures it and what he had talked about last week. So the income statement gives you a way to account for everything of value generated during the farm year, not just the cash that shows up on the schedule off, but do you have animals that are raised for breeding stock? Is there changes in inventory in your crops? That kind of thing. It also gives us a way to account for all expenses incurred, not just those that were paid in cash. And it tells us, are we generating adequate return from the farmer's devotion of time, labor, and money? Is this farm profitable? It gives you the monetary value of the farm business as it's determined by its profitability. I'm going to go over these pretty quickly because we were going to get into them a little deeper, but I did want to just remind you, those that were there, and to share with those that were not, what some of the measures were. The two primary measures of profitability are the rate of return on the farm assets, that is, the interest rate that is being earned on the investments in the farm. You want to have that higher than interest on borrowed money. It doesn't make much sense to be investing and growing at 3% if your borrowed money is paying at 6 or 8%. The other one is the rate of return on equity, which is the interest rate being paid for your portion of the investment in the farm. You want that to be higher than the rate of return on farm assets. So the income statement takes a look at includes all cash sales, government payments, custom work income. It also includes changes in inventories of feed, crop, livestock, changes in prepaid expenses, accounts receivable, payables, and accrued interest on the income side. On the expense side, it includes all cash operating expenses, including interest, but not the principal of payments. It also includes depreciation. And this was just an example. We'll dig into that a little deeper. Again, that was Paul's income statement, was just to show you an example of that. And from that, you can do the calculations, the rate of return on assets. In this case, showing almost 9% rate of return on assets. Not bad if you're on that. From that income statement, we can measure the rate of return on assets. Again, we'll get into this much deeper in the not too distant future, but just to share with you that. And of course, the rate of return on equity. In this particular case that Paul worked through for us, the rate of return on equity was higher than the rate of return on assets, and that 9% rate of return on assets is, I guess, not bad as long as you're not paying 10% on your loans. Some of the things that you can find out if you're not in the right with those numbers, take a closer look and find out that maybe you're investing at too high relative capital investments relative to your income, buying too much land or prices are too high. You may be setting your depreciation too high, putting little or no value on farmers' labor. It's tends to be a pretty big problem. People forget to do that. They forget to add in the value of their own time in this analysis. And we'll get more into these a little later, but these are some of the things that Paul pointed out. Also then talked about a cash flow analysis. And again, we're going to get into this in much deeper detail later. Just wanted to kind of touch base and share that. But the cash flow analysis, the statement of cash flows, is showing all the cash flowing into the operation and all the cash flowing out of the operation on an annual basis. So it's different than the monthly projections that we did earlier. This is on an every year basis. So you need to have your beginning cash and your ending cash balance. Then you look at the cash flowing in from operations, cash coming in from other investment activities, and cash from financing activities to give you the net change in cash, and then the ending cash balance. Here are some of the common problems Paul touched on: volatile prices of farm production and inputs combined with relatively high debt load. If you have a high debt load, you have a set amount of cash that needs to go out, and sudden declines in your prices and increases in input prices can really create a heavy burden on the farm if you're in a high debt load situation. It could be a debt structure problem, but it's probably more likely the level of debt than the structure itself. Production or sales falling short of productions. That gets back to thinking about our enterprise budgets here. If you're investing based on your enterprise budgets that aren't really based on reality, or something happens during the course of the year and weather takes a shortfall on that, then we're gonna be in a little tighter cash flow problem. Loss of non-farm income, that can always generate a little bit of a problem if you were relying on a certain amount of non-farm income, and some of the other ones. Again, quality of life needs to be the number one business goal, but you do need to have good financials in order to make that quality of life. You need to have cash flow, or positive cash flow coming in. You need to have long term. You need to have a good, strong, solid profitability. That's what it doesn't make sense to borrow money at 6% if you're only getting a 3% rate of return on your assets. You got to figure out how to flip those numbers around. Always do your balance sheet on January 1. Invest some money off farm. Even if it's a small amount, you can start to grow assets that way by saving a little extra out of the farm. And of course, 1 year's financial situation doesn't necessarily mean that your farm, having a bad financial year doesn't necessarily mean that your farm is failing. You don't want to get too crazy on that, but they might be able to see some things that change for next year. Long term, your financials are overall. And a couple of the parting thoughts here, of course, quality of life is the #1 business goal. It has to be. Being a farmer isn't necessarily about getting rich. It's about the life that you get to lead and the way you get to share that with your family. You do need to have positive cash flow to keep doing what you love, though. So it is important to have that in borrowing money understanding your farm's profitability allows you to know how and much you can afford to take on in debt. So if you're only getting 3% rate of return on your assets and you're borrowing 6%, you're going to erode your profitability really fast. That'll dive into cash flow problems for sure in the years to come. That January 1 balance sheet is a crucial time for you to do a balance sheet. It's a good thing to have those in place every year. Helps drive your tax preparation, as well as taking a look at how your farm is growing financially. Paul suggests even invest some money off farm. That's not a bad idea if you can afford to do it. Having a retirement account set up and starting to invest a little bit. Not all of your dollars invested back in the farm will give you some peace of mind over time. And finally, if you had a bad year, that's not the year that's one thing. If you're having several bad years, then you really want to think about making some big changes. You don't want to draw too many conclusions from one bad year. And again, we're going to get into a number of those. If you want to reach Paul, that's his contact information. And again, we're going to get deeper into this stuff. So just wanted to share with you some of the things that Paul talked about and drive home some of the things that Paul talked about last week. And we will keep plugging away on this. Keep working on your quality of life, understanding that by writing it out in your egg plan, and I will be commenting on those soon.